GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's as rare as hearing, don't worry, I already did the dishes. I'm your host, Jay Hamilton, and 2025 is not really starting the way we all expected. We've been talking about this everything bull that is all these things are lining up for this incredible year ahead. Historically, Q1 is one of Bitcoin's best quarters, so what gives? What's going on? Well, the answer lies in understanding some macro, what's going on with currencies, what's going on with bonds, some big picture items that are really having an effect right now. So in order to understand that, we brought on one of the great experts in the macro space. That's Michael Howell, founder of Crossborder Capital, a global research firm that monitors credit, liquidity conditions, capital flows in over 90 economies across the world. You have probably seen their charts all over Twitter. You've probably seen them in our newsletter. We share their liquidity chart frequently. So it's a big, exciting day to have Michael join us today. Before we jump in, we just need to take a moment to hear from our sponsors who make the show possible. Meet Odos, the DeFi aggregator that makes your token swap smarter, faster, and a whole lot easier. Tired of trading like it's 2019? Odos finds the best prices for your swaps across 900 liquidity sources and 14 blockchains, so you always get more bang for your crypto buck. Whether you're swapping, setting a limit order, or just avoiding gas fees like the plague, Odos has you covered. It's like having a genius trader in your pocket, minus the coffee addiction. Join 3 million wallets already using Odos to power over 6 billion in monthly trades. Start making smarter swaps today at milkroad.com/Odos. Michael, welcome to the Milk Road Show.
Great to be here. Lots to talk about. Exciting times.
I'm glad you're bringing the energy today because I'm a little bit worried. What's this current pullback? Even though in my head I know that structurally nothing has changed, and I'm still feeling quite bullish on this year. It's always a little concerning when we have a pullback like this. What's causing the market to have such a slow start to 2025?
Well, I think the fact is the markets never stand still, and they also never move in a straight line. And I think I rather think this year is going to be a little bit of a roller coaster ride. There's a lot of uncertainties around, and I think if you pinpoint two or three of those, number one is what is the incoming administration in the US going to do? First of all about fiscal spending, but actually more importantly about the funding question. How is that spending going to be funded? And that's got to be a big question for the US financial markets, not least because Janet Yellen, still the incumbent Treasury Secretary, basically cheated, if you like. I mean, that's probably an impolite way of saying that she did a lot of funding at the very short end of the market, which actually helped produce quite a lot of liquidity and was one of the reasons that the S&P and Bitcoin were actually pretty good last year. So I think there's that point. I think the other thing that we've got to think about is what's happening in China. That's a major uncertainty. The Chinese bond market is looking pretty volatile right now. Yields are collapsing. And that's telling you something about the debt deflationary environment the economy is facing. And if there's another thing, I think, to throw into that, the whole mix, the other big uncertainty, and probably perhaps in many ways the most threatening, is that from about mid-year, you start to get this debt maturity wall coming through. And the debt maturity wall, just to pinpoint what that is, that's basically the debt that was issued during the COVID time when interest rates were very low, near zero. A lot of corporations and governments termed out their debt. They issued it, or it was issued with maturities that are starting to now come to fruition around 26, 27. Actually, they begin in about mid-25. So a lot of that debt that was issued at that time during COVID is now coming up for renewal. And that's going to take a lot of liquidity out of markets. So these are the facts we've got to look at.
So does this concern you, this current pullback, or do you think this is just natural market cycle and everything's still looking good for the rest of this year?
Well, I think you've got to define short term and long term in this, and markets always move in cycles, that's for sure. And I think we're at a point where the cycle is not looking, let's say in the near term, that attractive. There are a number of uncertainties. I mean, our view anyway was that 2025 would see a peak in the liquidity cycle, was clearly a challenging fact by itself. And liquidity is one of the main drivers of asset markets in general, but particularly crypto and certainly Bitcoin. So we've got to pay attention to that. So number one, you were seeing a peak anyway. Number two, as I said, these other uncertainties have come through. And I think to focus on maybe a couple of those, I mean, one is, what is the Federal Reserve doing? And I think you've got to answer that question by looking back and trying to understand what they did last year. Now, we can look at a chart and try and understand what they were doing. And if you take a look at chart 7 that I put forward, that was called US Fed, we entitle it Not QE. What that is basically telling us is that behind the sort of rhetoric of the Fed doing so-called QT, what they've actually been doing in reality is injecting liquidity into markets. And what you can see here is the year-over-year change in the liquidity that the Federal Reserve has been injecting into US money markets. Now, clearly this is against the headline claim that they're doing QT, but beneath the surface, they've actually been pushing liquidity in. Now, that's a kind of wonkish, to understand that, it's slightly wonkish, because ultimately every item on their balance sheet is not liquidity creating. So they can shrink the balance sheet, but actually liquidity can still go up. And that's what's been happening. And Scott Bessent has been very clear in saying, or accusing Jay Powell of electioneering, and saying that a lot of these moves are actually trying to get Biden re-elected. So we've got that agenda or that fact. But you can see from that chart that the Fed impetus, if you like, is kind of running out of road now as we shift in towards 2025. And that line is going down. And that's got to be a question over the rest of the year, is whether the Federal Reserve explicitly now goes into a QE mode. I think they're going to have to at some stage, but they're not going to do it in the next couple of months. So we've got to take that into account. Then I think the next thing you need to look at is basically what the Treasury was doing, what Janet, the Treasury, was doing. Now, this is again a wonkish concept, but just because it's wonkish doesn't mean to say it's not important. And if you look at the next slide, which is entitled US Treasury Not Yield Curve Control, this is saying they're doing some unconventional yield curve manipulation. Now, what that means in practice is that they're issuing a lot of debt at the very, very short end of the market. So they've been issuing 1-year bills or bills up to 1-year maturity. They've been issuing very short-dated coupon debt, like 1, 2, 3-year notes. And they've done that instead of issuing longer-term coupon debt around the sort of 10-year maturity, which is more normal. And what that is that's a way of actually increasing liquidity in the system. It's technical. I'm not going to go into it now, but let's accept it's happening. And that's what you're seeing. Now, again, that coincided with Biden's re-election, or attempted re-election, one would say. And again, it looks as if the Treasury was up to some tricks. And if you add these two numbers together, you get the following slide, which shows the overall impetus of both the Fed and the Treasury in terms of what they were doing to the markets. Now, if you see the course of that graph, which is looking at year-on-year changes, interestingly, a lot of that impetus is explaining the big move in markets that we've seen in the last 12 months. And that is fading. I mean, there's no question about that so far. If we extrapolate that chart forwards, it's basically going down back to zero. And what you've had in 2024 is a very unusual combination of an S&P that's up 25% and a gold price that's up 25%. That's kind of unusual. Now, Bitcoin's clearly moved with gold because it's a monetary hedge. But what this is really underscoring is that what we're looking at is a pure liquidity phenomena here. Markets are driven by liquidity, and what we've had is a lot of liquidity going into the system. That is questionable. We're questioning that over the rest of this year. So let me pause there and say, number one is policy in the US is not going to be as benign, most likely, as it was last year.
So what we would want to see here is, and what's interesting about what you said is you don't expect the US to start any QE, QT, whatever we want to call it, but some form of liquidity providing. You don't expect that to happen in the next few months, but you think that they have to do that at some point in 2025. Are you confident that they will do that at some point? And do we need that to happen in order for the markets to have a good year?
Well, I mean, the answer is that we will get that because we have to get that. Am I confident of that? I'm 100% confident of that. The question is, what I'm uncertain about is the timing. And the reason that I'm confident of that is that if you look, and let me maybe try and do this with another slide. It's on slide 15, which is looking at a ratio between debt and liquidity in the world economy. Now, let me just sort of maybe start on page one and say, look, what we've got here is a situation where the world economy is suffering under a burden of debt. Okay. I think everyone accepts there's too much debt in the world. And in fact, if you look at the complexion of financial markets, the reason that financial markets are different today than what textbooks tell us is the textbooks tell us that capital markets are there to raise new money for investment spending. Well, long gone are those days, I'm afraid. Very few corporations in the West actually use capital markets to raise money these days. Capital markets are there to refinance debt. It's all a debt refinancing mechanism. Now, if you're in the textbook world of CapEx and raising money for CapEx, interest rates are important because that's the hurdle rate for your investment. But if you're rolling over debt, it's rather like rolling over a mortgage, refinancing a mortgage. It's not really the interest rate that really bothers you. What you need is the roll. You've got to get that, otherwise you're homeless. And the same with corporations. If they don't get the roll, or governments, they don't get the roll, they're bankrupt. So they need that roll. And what you need for that is balance sheet capacity in the financial system. Now, who creates that capacity, or who governs or controls that capacity? It's the central banks. They're the ones that will determine whether the banking system ultimately will expand or contract, or more generally, the financial system expands or contracts. Now, to talk as the Federal Reserve has loosely done in the past to say we need to shrink our balance sheet back to historic norms of circa whatever the figure, think of a number, $1 trillion, 2 trillion, whatever they say, is complete madness. I mean, what they have to do is to recognize the debt problem, and they have to increase their balance sheet pari passu or commensurate with the amount of debt. And the debt is accumulating, we know, rapidly, because a lot of people look at debt GDP ratios and say, look, these things are going to the moon, which they may well be. But the main metric, the most important metric, is not debt GDP, it's debt to liquidity, because debt has to be rolled over and refinanced. And that's what this chart is telling you. Now, if you look at this chart, what it explains is for advanced economies, going back to 1980, looking at annual data, it's the ratio between total debt and liquidity. Take liquidity to be the capacity of the financial system to roll that debt over. Now, when you get that ratio at a high level, you get refinancing crises. And those refinancing crises are illustrated on the graph. And I would venture that every single financial crisis that we can think of going back over that period is basically a refinancing crisis, whether it's the Lehman crisis in 2008, whether it's the 1997-8 emerging market crisis, whether it's the Eurozone banking crisis, or whether it's the 2019 repo crisis in the US, which I haven't labeled. But effectively, all those crises are about refinancing inadequate liquidity relative to the debt roll. If you're on the lower part of that diagram, below the dotted line, that's when you get asset bubbles, because liquidity is above what's needed to roll over debt. So there's surplus money in the system. And we've come through a period of abundant liquidity, as you can see. And a lot of that was helped by the fact that during the COVID crisis, interest rates were slashed to near zero. And so debt was termed out by corporations and governments towards the back end of this decade. In other words, what that's saying is that, debt was reissued in, let's say, 2020, 2021, 22, and it was issued to mature in 26, 27, 28, or whatever. Actually, that debt maturity wall begins about the middle of this year. It's coming back. Now, the reason for citing this, and the reason for mentioning central banks, is that central banks control the liquidity pool. What we need is a debt liquidity ratio that is below that dotted line. The projections show that, assuming the central banks do nothing, what's happening to that debt liquidity ratio is going up, because a lot of that debt maturity wall is coming in for repayment. And so central banks have got to be alert to that, unless they want financial markets to crash or to have volatility, they've got to be accommodative. So all this talk about continued QT is just complete nonsense, in fact. They're going to have to do something. And that's what central banks normally do. I mean, QE is not a new invention. It's been there since, for eternity, ever since central banks have been there. That's what central banks do. That's their job. They expand their balance sheets.
So what we're seeing on this chart on the far right side, and for those listening on the podcast, you're showing the projection of what will happen to the debt liquidity ratio if the central banks don't get involved, if they don't do some sort of QE. And so basically what that's showing is it's showing it's an upward line. It's showing that it's going to intersect with the red dotted line, which is basically the do not go here, danger zone, don't cross this. Otherwise, we're just going to enter another financial crisis, which every central bank's entire job is to avoid a financial crisis. Right. So you're essentially saying they have no choice. That's why you're 100% confident that the US is going to do something. You just don't. It's the timing that you're saying.
Well, it's not just the US. It's everyone is going to have to do this. But the Federal Reserve is the most important central bank, and they will do it. They will do it. Now, let me give you. I mean, this is the uncertainty is when, right? Not if. Yes. Is when, and that's why markets are going to be volatile. The other side of when is clearly very, very bullish for financial assets and for assets like gold or Bitcoin that are dedicated monetary hedges. Now, I want to show you another reason that this is going to happen is if we take a look at maybe slide 6, which is going back to China. Now, China is the other elephant in the room that I mentioned. And, you want to treat China with great caution near term, because if you look at this chart, what it's showing is a chart of the Chinese bond market, the 10-year bond, benchmark bond in China. And you can see towards the right-hand side of that graph that the orange line, which is the yield, has collapsed in the course of the last few weeks, last 4 or 5 weeks. You've had, something like, a 200 basis point, a 220 basis point drop in yields, which is, given the fact that we're now skirting with 1.6% Chinese yields, what we're probably historically used to in Japan, that's quite a big move. And the reason that's happening is that China is seeing debt deflation. Now, the reason that China is seeing debt deflation is that China has a problem, and that problem is called the US dollar. And China has always tried to shadow the US dollar with the yuan currency. China is effectively a dollarized economy and is trying desperately in the medium term to get off the dollar hook, but it can't in the short term. And as the dollar goes up, the Chinese are compelled or feel obliged to basically move up with the US dollar. The strong dollar is putting huge, huge strain on the Chinese financial system, and it's causing the central bank, the People's Bank, to extract liquidity as rapidly as it can from the money markets to try and hold the currency up. Now, the more that it squeezes domestic monetary conditions, the more that the Chinese economy suffers. And the more that the Chinese economy suffers, the more investors pile into government bonds because they are the safe asset. And hence yields in government bonds drop. So this is an ominous sign, and it's telling us there is debt deflation. Now, that cannot go on. And as you rightly say, central banks are in the business of protecting their financial systems. China's central bank is no different. And what will have to happen at some stage is China must devalue, or there has to be some deal done with the US whereby China is able to expand liquidity significantly. Now, that may come in the form of a deal that allows China to devalue against gold, and that will allow the dollar maybe to go up against gold as well, while maintaining a yuan US dollar cross that's not far away from where we are now. But ultimately, that backdrop is one of increased monetization. Now, I am confident that monetization is occurring in the medium term because it has to. China needs this desperately because they're suffering debt deflation. The US will have to face that prospect, not just because of the debt maturity wall, but because if you extrapolate forwards, the US government deficit is likely to remain large despite the best efforts of Elon Musk and co. It will remain large, and that debt is, broadly speaking, such a burden it will have to be monetized. So you're going to get monetization in the medium term. And therefore, what you come back to is a view that says, we may get more high street inflation. That's not necessary. I mean, I think that actually a caveat could be that if you see a policy of drill, 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 as Donald Trump promises, oil prices may stay depressed. And in that environment, high street inflation may be lesser a problem than people think. But you will get monetary inflation. Monetary inflation is not high street inflation. Bitcoin and gold are not hedges against high street inflation. They are hedges against monetary inflation, against devaluation of paper monies. And that's what ultimately you're getting. Now, with that in mind, the question is, what are we seeing now in the markets, and what does that mean for things like Bitcoin? Well, if you take a look at chart 16, what that's showing is the long-term relationship, and this is, again, maybe a wonkish graph for people that are not used to this, but this is looking in logarithmic terms of a chart of the Bitcoin price on the left-hand axis in log terms against the pool of global liquidity in dollars along the bottom. And what the two black lines that go through the orange dots, which are the data points, show is there's a fairly meaningful relationship between those two things. And in other words, Bitcoin is or has a compelling and strong relationship with liquidity. And I think liquidity is going up because monetary inflation, it's monetary inflation, in other words, and debt has to be monetized. Now, if you look at the following chart, that shows where we are in terms of a relationship that we've explored closely, looking at the data between Bitcoin and global liquidity. And let me just explain this because it's a critical thing to understand. And what it's showing is the orange line is Bitcoin, and it's the 6-week change in Bitcoin. Now, why have I chosen 6 weeks? The reason for choosing that is that it takes the noise out of the data. Financial assets are noisy. They jump around, obviously, on a daily or hourly basis. But what you want is try and get some idea of the underlying movements, the underlying trends. And I've chosen 6 weeks. Could have chosen 4 weeks or 5 weeks or 7 weeks or 8 weeks, but I chose 6. So that's either right or wrong. And then what I looked at is equivalently the same movement in global liquidity shown in black. But the difference here is that global liquidity series has been shifted forward by 3 months, which is 12, 13 weeks. So what you can see here is there seems to be a lead time, a consistent lead time on that data. Now, without going into the sort of mathematics of all this, because there's a lot of math behind this, but if you look at the following chart, which is probably the simple way of understanding this, this is a mathematical relationship that is estimated statistically from models, and it shows the response of the Bitcoin price to a liquidity shock. And the data along the bottom, the timeline along the bottom, is measured in weeks. And what that's showing is that the peak responses seem to line up almost exactly with that previous chart. Now, this is a sophisticated or whatever, robust but sophisticated methodology. It's using what is called in mathematical statistical parlance a vector autoregression model. And it basically shows that there is a very nice, plausible, and consistent relationship trade-off between global liquidity and Bitcoin. So it's saying that absolutely it is one of the critical things to understand when you're looking at Bitcoin. What we did is we explored the factors that go into driving Bitcoin, and we put those together in a pie chart, which is shown in the following slide. And what that says is that if you decompose the systematic influences on Bitcoin, you basically find these elements. Now, let me just explain those because I think they're important to understand.
Yeah,
and this
I agree.
Clearly,
this is a great chart.
this is clearly with the intention of saying that global liquidity is the major driver. In the short term, there is clear uncertainty about the path of global liquidity for the reasons I've said. China and the Fed are the big players, and we're not sure what they're doing in the short term, but in the long term they're going to have to come to the party big time, and that's why these hedges are critical to have in portfolios. What drives Bitcoin is a combination of global liquidity, which this is the systematic, the non-noisy bits. So I've got to, one's got to accept that there's noise on top of this, but systematically the signals that one can extract show that global liquidity is about something like 2/5 or 40% of the factors. You've also got other elements in there. Now, the other elements of note are, first of all, the gold price. And what that's basically telling us is, and this may be an influence that also doubles up on liquidity, but if the gold price is strong, you also tend to see Bitcoin being strong. So the two tend to move together. And that rather odd component that you see there, which is the ratio between gold and Bitcoin, is something that, again, which may be slightly wonkish, but it's if you're a statistician, you'll see there's something which is called an error feedback mechanism going on. Now, what I mean by that is that what happens if the gold price goes up by 100% and Bitcoin only goes up by 10%? You'd say that gold is overshot. So what you've got to do is to look at the equilibrium relationship between them. And what that component is saying is, telling us, is that gold and Bitcoin tend to move together. They correlate closely, but sometimes one gets out of line with the other. So there's got to be an adjustment back. So one of the things that you've seen, for example, in the last few weeks is that gold has been falling, but Bitcoin's been going up. Now, actually, in contrast, the reverse happened about 3 months earlier. Gold went up, but Bitcoin didn't. So there's an interaction, and that's what that term says. So you've got to look at this feedback effect. And then the last impact is investor risk appetite. And that's to say that you've also got to bear in mind that maybe to an extent, rather unlike gold or unlike alternative assets, Bitcoin does perform like a risk asset. And therefore, there's an element to say that if investors are spooked by geopolitical events or whatever it may be, or bad inflation numbers, like any other asset, is going to come down or go up accordingly. And therefore, risk appetite is also an element. But that's only about one fifth of the input. So these are the factors that are important. And what it's saying is that broadly, let's say 4/5 of the influences outside of normal asset markets. 1/5 definitely is related exactly to, as I say, through risk appetite.
Mhm. Yeah, I love it's so helpful to see a chart like this to simplify what is the systematic influences on Bitcoin. And it's interesting to me that global liquidity 40% feels low to me on global liquidity. I would have thought it would be higher than that, but I guess the gold price and the gold BTC ratio are also quite tied to global liquidity as well. So maybe that's where those
Yeah.
factors come out.
But bear in mind, this is the breakdown of influences. It doesn't say what the multipliers are. So, in other words, that if you look at that previous chart, you'll see there that a 1% shock to liquidity can cause much, much bigger increases in the Bitcoin price. So liquidity may go up 10%, but Bitcoin could go up 50%.
Okay, so I know you don't have a crystal ball, and I know you can't predict the future, but I'm going to ask you to do your best for us. What, how do you see the rest of 2025 playing out? What's your thesis? Take us through maybe quarter by quarter.
Well, I mean that's a big ask, but I think the first quarter, maybe the first and second quarters could be quite tricky, because I think this is where you'll face a lot of these, where you'll confront a lot of these problems. I think there is a question mark from mid-year generally because of this debt maturity wall, but hopefully by about mid-year we may get some clarification about what the Federal Reserve and maybe what the Treasury are going to do. And I would surely think by mid-year we're going to get further insight as to what's happening in China. So I would say that the first half year, to my mind, is going to be a lot more uncertain. My strategy, in my investment strategy, is long term. I mean, I definitely own monetary inflation hedges like gold or Bitcoin. I think these are fantastic assets to hold. In the very short term, I mean, I'd be thinking much more of being a lot more conservative and maybe looking at something like a 2-year note. But I mean, that's only because I think there could be some nastiness happening in the short term. And in terms of what am I doing tactically, I'm thinking that if I can pick up Bitcoin below 70,000, I'll certainly do that. I may be that may be a long shot to hope for that, but I think that it's a volatile asset class and maybe it comes back. But that's what I would be thinking. That's not a prediction, but that's
Mhm.
just a tactical, line in the sand. What do I think Bitcoin can do over the medium term? Well, I mean, I've been on record several times. I think on a 3-year view, I think it could easily be 250,000. So it's. I think the trend is definitely there, and people ought to own it. There's no question about that, because monetary inflation is here, and what average investor and maybe what the average Joe out there doesn't understand is that the funding environment is so dire for governments that they've just got to monetize. Look at the fiscal deficit. I mean, how often do you see 7% fiscal deficit in America? You don't see that very often. I mean, this is a big funding issue. This has got to be funded. The tax base is squeezed dry. Spending is going up because of defense, because of welfare payments, etc. The Social Security fund will be emptied by, I mean, well, you choose your number, but I mean, it's upcoming in America.
So, and you're not the first person to say Bitcoin could go as low as 70K, and that would be an incredible buy if it went that low. I mean, obviously, maybe it does, maybe it doesn't, but I think the point that you're making, which is really a point that I want all of our viewers and our listeners to hear, is be prepared for a lot of volatility through this next quarter, possibly the second quarter as well. Do you think that there's a possibility? So you seem to have this mid-year mark in your mind. Is there a possibility that Trump moves faster than that and things happen within the first 30 days in his office, within the first 100 days in his office? Or is there a reason why you really have that mid-year mark?
Well, I think the reason for the mid-year mark is that the Federal Reserve is going to have to do something. I think in the near term, it's going to have to be clear. Bessent has got to be clear about how he changes the funding arithmetic. I mean, he's been very critical both of Jay Powell and of Janet. Accusing Janet of effectively operating policy for an emerging market rather than the US. Both he and even Stan Druckenmiller have said that the sort of numbers that are coming out of the Treasury are sort of more akin to a Latin American economy. Although we've got to be careful what we say here, because clearly Argentina has tidied this act up significantly. But those are the risks. And the big question is, when you start to get funding. I mean, funding is going to. I mean, you're looking probably by about Q2 of seeing some serious funding questions emerging, because you're getting the tax payment system. Tax receipts are really going to come in strongly around April time. So you've then got May, June to think about, and that's when funding is going to start to come through again, or going to call on the markets. So he's got to be clear about whether he's going to go down the bill route still, whether he's going to fund at longer term maturities as he's promised. And that's one question. And then I think the other question, which is a much, much bigger question, is, what does the Federal Reserve do about QE? Does it restart? I think it's got to. That's my view. If you look back at the repo markets, which is really what this is all about at the end of the day, the repo markets are seeing increasing tensions. If you look at SOFR rates, which is basically the headline or the anchor interest rate in the system, not Fed funds, it's really SOFR rates that's the key thing. They're the repo rates, and they're blowing out relative to Fed funds. That spread is widening systematically or continuously. If you start to see big jumps in that spread between SOFR and Fed funds, it tells you there are funding tensions in the repo markets. We've had a notable number of those through 2024, but interestingly, 85% of the jumps in that spread, the worrying jumps in that spread, occurred since July of last year. So you're seeing an increasing number, and that's telling us that things are getting tighter. So the Fed has got to start thinking about this pretty seriously sooner rather than later. So those are issues. Then I think if you stretch this out longer term, Scott Bessent's been very clear that what he would like to see is some reset in the global financial architecture, talking maybe in terms of a Bretton Woods 2. Now, I don't know what shape that would take, but my view would be that ultimately out of that, because it's in everyone's interests and needs, is you're going to have some form of monetization. And I think that means a much higher gold price. Now, if you get a higher gold price, you're going to get a higher Bitcoin price. But let's see.
Yeah, it's it all sounds great. The challenge that with all investors is just knowing how to time it and when this is all going to happen. And it's really nice to have you on the show, Michael, because you really point out how many of these big government central bank factors are impacting the markets. And a lot of us don't pay attention to that on a regular basis, which we really should. One reason why you guys should follow Crossborder Capital on Twitter. We'll make sure we put the link in the show notes. Michael, thank you so much for joining us today. Thanks for your time. It's been an absolute pleasure.
That's great. Yeah. I mean, take a look at Capital Wars, our Substack, which is maybe a good route in.
Yeah, for sure. We'll also put a link to that in the show notes as well. It's a great read. Thanks for listening in, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.